Here's where things become even more interesting. Large institutional investors, hedge funds, pension funds, and major asset managers rarely wait for the official rate cut announcement. They monitor economic data months in advance. They analyze treasury yields, inflation trends, labor market reports, and corporate earnings projections. When bond yields begin falling sharply before the Fed acts, it often signals that sophisticated investors expect slower growth ahead. By the time the rate cut becomes public news, much of the strategic repositioning has already taken place. This creates a gap between professional investors and everyday investors. Retail investors often react emotionally to the headline, buying stocks aggressively because borrowing costs are lower. But professionals focus on context. They evaluate whether inflation is under control, whether consumer spending is weakening, and whether corporate profits are under pressure. Because if rate cuts are happening due to recession risk, stock prices can remain volatile even as rates fall. Another critical factor to consider is sector performance. Not all industries respond to rate cuts in the same way. Early in a rate cutting cycle, defensive sectors like healthcare, utilities, and consumer staples often perform relatively well because their revenues tend to be more stable during economic uncertainty. Growth sectors, particularly technology, may benefit later once economic confidence begins to recover. Timing plays a major role. Investors who assume that every rate cut immediately fuels a broad rally may be overlooking the natural rotation that happens within the market. Inflation also plays a key role in shaping outcomes. If inflation remains stubbornly high, the Federal Reserve may cut rates more cautiously than markets expect. And when expectations are too optimistic, disappointment can trigger volatility. Financial markets move not just on policy decisions, but on the difference between what investors expect and what actually happens. Sometimes, even when rates are cut, markets decline because investors had already priced in a larger move. There's also a broader global impact to consider. When the Federal Reserve changes interest rates, the US dollar often reacts. A weaker dollar can boost multinational corporations by increasing the value of overseas earnings. A stronger dollar can tighten financial conditions worldwide. Global markets, including those in Europe and Canada, respond to US monetary policy shifts. Even if you invest only in American companies, these currency and capital flow dynamics can influence earnings and valuations. So how should individual investors respond strategically? First, focus on economic trends rather than headlines. Monitor unemployment claims, GDP growth, and consumer spending patterns. Second, pay attention to the bond market, especially the behavior of short-term and long-term treasury yields. An inverted yield curve, for example, has historically signaled recession risk. Third, maintain diversification across sectors and asset classes to reduce exposure to sudden volatility. And finally, prioritize risk management. Avoid excessive leverage and keep sufficient liquidity so you can take advantage of opportunities if markets pull back. The key takeaway is simple but powerful. A rate cut is not automatically a buy signal. It is a signal of change. It indicates that monetary policy is shifting in response to economic conditions. Sometimes that shift leads to renewed expansion and strong market gains. Other times, it reflects deeper economic weakness that takes time to resolve. Investors who understand this distinction are better prepared to navigate uncertainty without being driven by emotion. Wall Street thrives on excitement because excitement drives trading activity. But long-term success in investing depends on discipline, patience, and understanding the bigger picture. The next time you see headlines celebrating a rate cut, pause and analyze the context. Ask why the move is happening. Look beyond the immediate reaction and consider the broader economic cycle. By thinking strategically instead of emotionally, you position yourself ahead of the crowd, and that perspective can make all the difference over time.